Rising sea level derivatives, meanwhile, rely on tidal gauge data and long-term projections, allowing investors to bet on the pace of coastal inundation from Miami to Manila. These new instruments reflect a shift in how investors approach climate risk. It's no longer just about insuring against a single hurricane or wildfire. It's about constructing portfolios that capture the full spectrum of environmental volatility. Hedge funds now short regions deemed unlikely to receive adequate disaster relief, betting against the economic prospects of counties with outdated flood controls or cities that delay infrastructure upgrades. Some firms employ former disaster response officials to analyze local preparedness, translating that expertise into trades that profit when recovery efforts fall short. The overlap between climate mitigation and climate profiteering is striking. The same firms that dominate carbon credit trading, selling emissions permits and renewable energy certificates, also structure catastrophe bonds and climate-linked derivatives. A trader might spend the morning negotiating offsets for a European utility, then pivot in the afternoon to package wildfire risk for a California insurer. Internal memos describe this as a climate risk ecosystem, where every environmental outcome, improvement or deterioration, offers a stream of revenue. Municipalities have started to respond by issuing climate resilience bonds, a new class of financial instrument designed to hedge against their own failures. Miami Beach recently floated $400 million in bonds that pay investors only if specific flood protection projects prevent damage during hurricanes. In Norfolk, Virginia, the city structured bonds with interest rates that decrease if sea level rise outpaces projections, effectively transferring some of the risk back to investors. These deals represent a reversal of traditional catastrophe insurance, with local governments betting on their ability to adapt and investors wagering on the opposite. Quantitative analysts have developed climate-specific analogs to traditional volatility metrics. The Catastrophe VIX aggregates implied risk across disaster-linked bonds worldwide, while regional sub-indices track wildfire severity in California, typhoon exposure in Southeast Asia, and drought risk in the American Midwest. Trading desks use these benchmarks to rebalance portfolios. In response to shifting weather patterns, executing trades as soon as new data emerges. Underwriting climate-linked securities now requires a blend of actuarial science and environmental modeling. For Texas windstorm bonds, models incorporate decades of Gulf temperature records, historical storm paths, and even shifts in local building codes. The most sophisticated analyses factor in climate gentrification, the displacement of lower-income residents as wealthier buyers seek out safer areas, altering the risk profile of entire neighborhoods. These models are continually refined as new data becomes available, with each update feeding directly into bond pricing and investor exposure. The secondary market for climate risk has grown in both scale and complexity. Electronically traded catastrophe swaps allow investors to adjust positions by the hour, responding to changes in storm trajectories or wildfire forecasts. During the 2024 hurricane season, daily trading volume in Gulf Coast wind derivatives reached $750 million, as funds jockeyed for position ahead of each landfall. Algorithmic trading systems execute orders automatically when NOAA updates storm probability cones, moving capital in real time as risk is repriced. Private equity firms have entered the fray, acquiring entire portfolios of climate liabilities from insurers eager to shed exposure. Blackstone recently purchased a $2 billion package of Florida hurricane risks, collecting premiums for years while waiting for the next major storm. Since 2020, over $18 billion in climate-linked liabilities have been transferred from traditional insurers to institutional investors, shifting risk away from the balance sheets of local companies and into the portfolios of global asset managers. The market has also begun to internalize climate feedback loops, where one disaster amplifies the risk of another. Bonds now account for how drought increases wildfire frequency, which in turn reduces watershed capacity and exacerbates future droughts. Some instruments link payouts to indices that track these cascading failures, creating a financial map of interconnected environmental risks. Climate science is distilled into formulas and payout schedules, with each new degradation assigned a corresponding metric. Residential mortgage-backed securities have adapted to this new reality by incorporating climate risk layers. Algorithms evaluate not just borrower credit scores and down payments, but also a property's flood zone rating, wildfire defensibility, and proximity to vulnerable infrastructure. Loans for high-risk properties are bundled into specialized climate mortgage securities, offering higher yields in exchange for elevated exposure. An echo of subprime lending, but based on geography rather than borrower behavior. Corporate issuers have also embraced climate bonds as a tool for managing volatility. Agricultural firms issue securities tied to crop yields that fluctuate with drought and extreme weather. Shipping companies float bonds covering port disruptions from rising sea levels. Even technology giants hedge against data center overheating during heat waves, using temperature-linked derivatives to manage operational risk. The insurance-linked securities market has ballooned, with over $150 billion in collateral now funding climate risks. Pension funds, seeking diversification and uncorrelated returns, have become major buyers. CalPERS, the largest public pension fund in the U.S., allocates more than 4% of its portfolio to weather derivatives and catastrophe bonds, aiming for returns that spike when traditional assets falter. The appeal is clear. Climate-linked securities offer a rare source of yield in a world of low interest rates and high uncertainty. Yet the incentives embedded in these products often run counter to adaptation and resilience. Some coastal communities reportedly delay flood prevention projects because disaster payouts can exceed the cost of mitigation. Farmers in drought-prone regions may plant less resilient crops, knowing insurance claims will offset losses. The logic of the market sometimes rewards inaction and even amplifies vulnerability, as the prospect of financial gain outweighs the incentive to reduce risk. Oversight remains limited. Many climate derivatives are settled through offshore special-purpose vehicles in jurisdictions like Bermuda and the Cayman Islands, beyond the reach of most regulators. Banks repackage risks into increasingly complex structured products, making it difficult to track exposures or assess systemic threats. The memory of the 2008 financial crisis lingers, as some observers warn that climate risk transfer mechanisms could amplify shocks on a planetary scale. Innovation continues at a rapid pace. New products track glacier melt rates and their impact on hydropower generation. Others allow investors to bet on climate migration flows or the frequency of famine declarations. Swiss Re has launched an instrument that triggers payouts based on the number of climate-related emergencies declared by national governments. Each new contract expands the universe of tradable risk, bringing more aspects of environmental change under the umbrella of finance. Financial firms increasingly view the Earth's instability as a form of market inefficiency to be exploited. The models that forecast ecological collapse are the same ones that structure profitable trades. Climate science becomes a set of volatility curves and probability surfaces, raw material for the next wave of financial innovation. The boundaries between risk management and speculation blur, as every disaster, whether sudden or slow, feeds into the machinery of global finance. The paradox is stark. Markets can now price climate risk with astonishing detail, yet these mechanisms do little to address the underlying causes. A trader can calculate the expected loss from a Category 4 hurricane in Tampa down to the dollar, but that knowledge does not prevent the storm or mitigate its impact. Instead, climate change has become a high-stakes game, where financial institutions profit regardless of the outcome. This transformation has shifted the burden of environmental risk away from communities and onto the balance sheets of distant investors. The same mechanisms that once protected homeowners in cities now serve as tools for speculation and profit extraction. The consequences of this shift are still unfolding, as the market for climate risk grows more sophisticated and more deeply embedded in the global financial system. With each passing season, the linkage between environmental catastrophe and financial opportunity tightens. The systems built to manage risk now operate at a scale and speed that few could have imagined a decade ago. The next phase of this evolution is already underway, as traditional insurers move to offload even more risk to the global capital markets, reshaping the relationship between disaster, finance, and recovery.